Gentlemen, how we doing?
Good. Doing great.
You.
Hey, got through August, getting working our way through 2025, month to month, having everyone join us. It's been a great year so far on many fronts. But
it's amazing that we're through August. I put a birthday in the rear view in the month,
Right.
but the market didn't seem to care. It just kept marching up.
That's all right.
So that was a good thing.
Well, hey, let's look at the market.
Yeah, let's jump in. So, we like to look at the two cornerstones of a traditional portfolio for a retiree. We like to focus on the S&P 500 as our gauge for the equity markets or the stock markets, as we like to look monthly. So we saw the S&P 500, top 500 companies in the U.S. by market cap, up 1.91% in the month of August. That was tremendous. And then we like to look at a bond benchmark as well, to kind of tell us how fixed income has done in any given month. And the aggregate bond index basket of bonds was up 1.2% for the month of August, which, again, you're starting to see a different trend play out here. Does the trend hold? Don't know. Too early to tell. But if you remember us talking a lot about interest rate volatility more to the upside, probably for the last 18 months or so, leading up to a couple months back, now you might see a season of change in where rates are going. Too early to tell, but again, we did finish the month with a positive, return on those bonds, broadly speaking. Yeah.
Right. And, we always start the podcast, kind of looking at the market, looking at the portfolio. Mm-hmm. So with a month like we just had, kind of looking at the portfolio, for the last month, anything that we're looking at or looked to do?
So there's a couple of concepts that we like to pull out and speak to when it comes to investing, not trading, investing. This is where time is your friend. Slow movements, but accurate surgical movements are what you expect in in an environment where you're an investor really trying to gain an edge on just the general markets. So in portfolios, we are setting up for a changing of season, if you will, in the interest rate world. We are starting to put into place things that will react very positively to interest rates coming down. Now, not all interest rates are created equal, and there's a lot to unpack here when you look at the yield curve, but we are starting to set up for perhaps a different bond market in the months to come. Starting to set up for that. The other thing that we're doing is recognizing volatility and liquidity and understanding that there is a pulse in the market that speaks to the ferocity that we see of movements. And when that ferocity kind of abates and gives us a more sanguine environment, that's a go signal where if you're going to take some risk, you take it then. Right. And we've been paying attention to this. Obviously, it didn't just happen in August, but we're continuing to build out and lean on that trend. So the portfolio update is, again, adjusting the sales to the winds that always change, making sure that we're hooking up efficiently for the environment that we're in. But we haven't done any big major changes, but clients will notice the continuation of just a little bit of transaction and movement.
Yeah. And as we're kind of maybe, not to kind of say what you had said, but maybe as we're trying to put things into place, looking ahead, some might call it a meeting of the minds.
Yeah.
And over in Jackson Hole.
Yeah.
I mean, how do we read that or listen to that as we're kind of looking at these things?
So meeting of the minds, again, when you look at our authority on monetary policy, you're going to find the Federal Reserve officials. Chairman of the Federal Reserve, Jerome Powell. It goes back to the 1970s where they started to meet annually in the mountains at Jackson Hole, get away from it all, find peace and serenity, and talk about what they feel is relevant in monetary policy, world. I don't know how they come up with that because it seems pretty straightforward to me. But they've got all sorts of breakout sessions and stuff. But what happens is all the Federal Reserve officials get together and have this 2-day meeting. And at the conclusion of the meeting, the chairperson, in this case Jerome Powell, gives an address to the people. And what it speaks to is looking at the next year and what are the priorities and motives of the Federal Reserve. That's where you start to see winds changing. That's where you start to really pick up on specific words and verbiage that are meaningful to the direction that the Fed takes. Remember, there are two main levers with impacting the economic kind of heartbeat. And that's you can either speed it up or slow it down. And those two main levers are fiscal policy, that's just acts of Congress. The other one is monetary policy. That's what the Fed does. And so why was that Jackson Hole address so important and impactful? It's a once a year, and it's forward looking, and it speaks to everything related to money supply, interest rates, and things like that. That's where you can pick up those winds changing, those tones changing, the use of specific words changing. And what did we unpack from it? The Fed feels that we're getting to a place that would warrant interest rate reductions.
Right.
And so that should unlock some pieces of the economy that have been tightened up for a while. So why does the portfolio need to hook up to that? Because that's what the portfolio is there to do, seek opportunities. So that Jackson Hole address happened in August, and quite frankly, the market liked what it heard.
Right.
Well, continuing on that market piece, right? Markets have obviously been very good the last couple of months. We've seen a lot of positive momentum here. Has it just been tech like we've seen in the past, or what's been the breadth of the market? Has everything kind of moved up, or is sector specific?
Right.
What have you kind of seen?
So that's a really good question, because what we will unpack from that is you're speaking to wider breadth in the market. Because the S&P 500 is very much dominated by, say, the top 3 companies. Because remember, the S&P 500, it's the top 500 companies. But the larger a company is, the bigger percentage it represents in that index. So figure a good piece of the entire index is represented in the top 3 companies. Now, that means that if those top 3 companies do well, it could pull the whole market up. It could pull the S&P 500 up, and the 497 companies could languish a bit. Breadth happens when you see all those 500 companies working together. Or how about not just those 500 companies, but you then pull in medium and small size companies, even smaller size companies. When you start to see more participants in a move, you can trust that move more. So if you would say, okay, the S&P 500 top 500 companies, well, what about go to the 501 and the 2,000 companies below that? Those are going to be medium and small size companies. The Russell 2000 had a tremendous August, way better than the S&P 500. And so what that is a building out of breadth, and that's more participants, and that's actually a very healthy sign for this continuation of growth.
Well, and then how did corporate America look? I mean, as far as earnings go.
Right. So earnings, again, we closed out, and it feels like forever ago, but closed out month of June, and then companies report for the month of July and into the month of August. So we closed out the second quarter of 2025 reportings, and astonishingly, corporate America is doing very good.
Right.
Analysts, for whatever that means. I mean, analysts they come in many shapes and forms, and they're not always right, by the way. But anyway, analysts thought that earnings would be rather flat for the entire year, and we're seeing, double-digit year-over-year growth, depending on what index you want to look. I'm specifically referring to tech-heavy. But again, that's kind of the dominating force right now. So let's focus on it and make sure that it's healthy and it's still intact. But yeah, I mean, earnings were very impressive. So that's a box we can check that says this is still very much intact, lining up with some of these other fundamentals.
Again, so good positive momentum, for the markets, along this strong economic backdrop. What about housing and the consumer and jobs reports? What are we seeing there?
That's part of that strong economic backdrop that you just referenced, right? So you've got not only corporate America working, there's some things that I think headlines be ready for. I mean, is the jobs data accurate? I don't know. I don't know that I've ever really trusted it a whole lot. But one way or the other, there's been some huge revisions and changes. But on balance, the consumer is strong. So what does that tell you? The jobs, some way or shape or form, consumers are getting money to go spend. So you can kind of trace that back to there's probably ample opportunity for jobs. Now, what's the official number? That's kind of up in the air right now. But if you look at housing's still robust, the consumer, and that was really a key point in August that the consumer was very robust. And I think it speaks to the earnings growth that we saw as well. But so housing looks decent, consumer robust. We'll put a question mark on the jobs front, but we got to assume with housing and the consumer, it's okay. So you get these things with a strong economic backdrop, the building out of breadth and stuff, and you can be really constructive on where we're at. And that doesn't take away from the volatility, everyone. There will always be volatility, and we are in a headline-driven market. Those are the most choppy types of markets. But these are the things you've got to pay attention to so that when the heat gets turned up, you've got a plan and you really know what the underlying is. Because remember that the market doesn't always get it right. The market is an inefficient mechanism that provides liquidity. Think of it like a big auction. Well, who showed up to the auction? How are they feeling that day? Recognize when you own a stock, you own a business. And that auction is a mechanism to gain liquidity. It doesn't always get it right. Always know what you own everything for a reason, own the things because of what matters truly. Give this time. And so what we're speaking to is this is a robust environment based on all the check it down elements we would look at in a portfolio. And this discussion kind of just builds that out.
Yeah, well, and even with the potential looming like rate cuts, like we're talking about, that sets up for maybe some people that are sitting on the sidelines, maybe not looking to move out of those 3% mortgages that they have, right, and kind of maybe waiting for an opportunity to see rates come down, mortgage rates come down, and then make a move too, which again sets up for that strong backdrop that we're in.
Well, how about this? Recognize that there's still an immense amount of cash on the sidelines. Yeah. It's been enjoying 4% money market rates. Money market rates are very much tied to the federal funds rate, which is the rate that Jay Powell and his team impact. When that rate comes down, money market rates come down. And then somebody's going to go, those CDs, this money market, it's not as effective for me. James, right. Derek, what can you do different for me? That's where that stimulus comes in. That's how that pushes money supply out into the economy. It's just one way. The other thing would be it's easier to get a loan. That right. brings money out into the economy. So that's exactly right. That's how it's stimulative. That's a monetary policy lever.
Right. Yep. When you talked a lot about kind of like the headlines and breadth of the market, but if we kind of look, and I know all of us have done this for decades, right? So one thing that's really been interesting is the international markets, right? Looking over the last 12, 18 months and how they've moved. Yeah. What do you think about that?
now I'm going to talk to you like we're on my back deck, having a beer or something like that. Because, you could get the just general, I don't know, I could give you a really boring answer on that. And to just talk about, the international space had a lot of catching up to do. Valuations still look cheap over there. In a way, sometimes valuations, they're called value traps. They'll always be cheap. Yeah. But I think what were some of the things we were talking about earlier this year? Trade relations, right? Well, the U.S. stock market is not simply reserved for U.S. citizens. There's people all over the world that have come and recognized we've got the best companies in the world. Yeah. I mean, that's my opinion, but truly, challenge me on it. So you go and you look around and there's a huge appetite for U.S. stocks until you piss people off. Yeah. And again, this isn't scientific. Right. This is just, so you go and upend trade relations or put them in a position of vulnerability. A lot of times the impulse is, I'm going to sell those U.S. stocks. And then whenever you would sell those stocks, the money still needs a home. So where does it go? Well, I don't know. Gold's rallied pretty good here. Yeah. International stocks, they provide an alternative. But I think when you look outside of our borders, there are some things you really need to pay attention to. And maybe that's something we put down in a future podcast. Yeah. What are kind of some of those pitfalls? But look, the international markets have a lot of catching up to do, even with their robust move this year. Right. I think that it's probably more in line with trade relations than true fundamental pickup. But yet again, we can maybe have some fun with that in a future podcast.
Maybe on that porch.
Depends what our audience wants.
Right. So if we're looking ahead, right? We're looking at September. What do we think we're going to see there? Yeah. We got a couple big dates.
And think about this. I mean, the backdrop looks robust, but the markets have just been on a blistering move higher. Now there are things that exist called melt ups, and we do have the the things that would go into that stew. We do have that as a potential. Melt up is where the market does something so shocking to the upside. Everybody celebrates it, but it's a head scratcher.
Yeah.
I don't know that we're there yet. It seems like this market needs a little bit of volatility, and it needs to work off some of the excesses. So I would just be a little bit cautious, but be optimistic about the opportunities that exist out there, because yet again, time is a really important function to this all playing out. The volatility that comes with the headlines, it comes with the market just needing to, it goes up big time, it needs to come and test that, make sure everybody was sure they wanted to buy, right? I mean, that's what it is. Yeah. And so, you probably get some of that movement, but don't forget the backdrop. And we won't either, because that's what we're here.
Can we put you on the spot? We've got the Fed meeting. Do we think we're going to see a 25 basis point cut, a 50 basis point cut, or do you think they'll stay neutral for one more?
Yeah, so we'll get this in September. We'll know what they did. Yeah. We'll know what they did. But I would tell you this: if they don't cut, there's probably some reason out there that isn't necessarily economically linked.
Yeah.
So
Yeah.
I mean, we're there. Yeah. I think we can accept a cut.
We'll find out.
Yep.
We'll find out
next month.
Thank you for joining us. Thank you. And we'll see you guys next month.
It's an honor.
Advanced Capital Management Incorporated is a registered investment advisor. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk, and unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor before implementing any strategy discussed herein. Tax and estate planning information should not be construed as formal legal or tax advice. Always consult an attorney or tax professional regarding your specific legal or tax situation. Thank you, and we look forward to seeing you next month.